Well, welcome back. Ladies and gentlemen, today we're going to be discussing the Canadian tax system. I've quoted many times that Canada wants you to be rich, but I really want to kind of backtrack this a little bit and talk about the tax structure that currently exists in Canada because it has changed recently, putting a little bit more money back in Canadians' pockets. But if you really want to put that money in your pocket, you're looking to expand business, understand some of these, I wouldn't say tax loopholes, but the way the tax system works so you can fully take advantage of your money. And I'm somebody who's done this kind of self-educatingly. I really wish I learned a little bit more about CPA work, but we're going to actually listen to a professional CPA. And this was the video that actually inspired this live stream. And he makes a lot of points and things that I'm already iterating into my business, into the way I invest. And I think it's really healthy to take a 60,000 foot view down and just kind of get an understanding of how the rich are actually structuring their investments and their taxes in this world. And what I love most about this video is a lot of you guys that watch this channel, I've actually seen comment, like Jason down here has been commenting on this. He usually joins our live stream. A lot of good comments, a lot of intriguing stuff going on. So if you're on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button because yes, between all of my accounts, I utilize a variety of tax systems, whether you're talking about a tax-free savings account or a registered retirement savings plan. We have the luxury of an FHSA for those looking to build up, some income tax-free, basically to put down on a property here in Canada. The government has introduced a variety of ways of saving money on your taxes. But when we start talking about the final boss, to take it to the absolute extreme, where I think the most money and the most benefit comes from is in the latter half of corporate investing. And we're going to get there in a moment for those that are familiar and those that want to brush up on the capabilities you have under a corporation. And again, from that 60,000 view, I think even if you're someone starting out trying to figure this out, this will be the video for you. We can round back to my portfolio, any Q&As you guys might have when we get to the end of kind of what I want to walk through here. So feel free to leave your comments. But first and foremost, every single one of you right now should be using any kind of a tax calculator. I do like Wealth Simples because it gives a very clear view. I know we're in 2025. Taxes haven't changed that much this year. Nonetheless, this is really going to help give you a view of how the middle class basically subsidizes the entire economy. It is the middle class that pays the most taxes, and you see it in the way taxes are set up. From employment income, the average salary, I think across Canada right now is around $62,000. So to keep this clear and easy, we'll just say if you made $60,000 in a salaried income, you'd be paying about $13,441 in taxes. Not terrible, not great either, but I wanted to show you, obviously, as you expand that, like if you're making over 100K, your tax bracket goes up to that new marginal rates, but we're just going to use 60,000 because I think this is just going to blow your mind. If you take 60,000, you're going to pay that 13,400 on, and let's say we were able to get it as a capital gain. In the same boat on that capital gain, we'd only be paying $3,300. So if you made 60K as a capital gain versus salaried income, you'd be paying an average tax rate of 5.56%, right? So let's talk about an eligible dividend. If you made $60,000 instead of a salary, but instead in an eligible dividend, you would only pay $750 in taxes. What about an eligible dividend? So let's say you're not getting it from a Canadian company, because to be eligible, the company has to make 50% of the revenues in Canada. But let's say it's not eligible. How much would we pay then? Oh, $4,600. Still less than a third of what you would be paying from a salaried position with an average tax rate here of 7.67%. This is insane to me. And the more I learned about this, the more I was like, everybody needs to join the investing class, because it is insane how if you reach a certain level of wealth, your income, that you can make off those investments can literally subsidize a salary, and you pay virtually no tax on it and have that in perpetuity for the rest of your life, especially if it's in some of these tax shelters accounts like a TFSA or an RSP. And this kind of calculation should also help you understand how you're utilizing, say, a TFSA or an RSP, because, let's say you want to buy Canadian dividend stocks in a TFSA. Well, if you're taking a look at the actual tax savings you're going to get, you might be better off looking at higher risk investments, things that are going to offer larger capital gains, things that might not be Canadian dividend stocks, because even if you held Canadian dividend stocks outside of a TFSA, on that first 50 to 60K of dividends, so if you invested $1 million in a Canadian ETF, for that 5% you're going to make, it's all tax-free for the most part anyways. And the capital gains, if you do need them at some point, are crazy reduced. incomparable. So these are things you can start thinking about, because I know a lot of people just want to own Canadian dividend stocks, but I think a TFSA with nuance, you'll understand that maybe taking on some risk or looking at investments that might have more tax implications on them could be the better route to go in your kind of planning and your investment strategies. Now, we did see that tax cut in Canada for the first $57,375 earned. They're taking the tax rate from 15% to 14%. So in totality, the average tax savings will be about $420 per person and $840 per couple in 2026. I find it hilarious that they fell on 420. Not sure if that was just accidental or what, but still funny nonetheless. So this is just basically the government trying to offer a bit of alleviation in the inflationary cycle we've been through, but God knows they're going to find a way of getting that tax somewhere else. They always do. It's one tax cut here, find it somewhere else. And to be honest, if $420 a year in savings makes a huge impact on your life, you really need to look at finding ways of being a bit more frugal on one end, or finding another shovel of income you can bring into your household, because $420 a year doesn't really get me all that excited. God knowing the amount of inflation we've been through the last 5 years, that doesn't really equate to much, and I'm sure it doesn't for many people out there. But nonetheless, let's get into this video, and I just want to break down purely only the corporate structure of investing. It does start a bit boring, but it gets way more intriguing as it goes, I promise. But I just want to watch 2 or 3 minutes of this very intriguing part of this video, and I'll offer some insight along the way.
Let's dive into how smart Canadians legally minimize their taxes across income investments, business structures, and estate planning. Strategy number 1, use your corporation for strategic income splitting and deferral. If you're a business owner, incorporated professional, or consultant, your corporation isn't just a place to run your business. It's one of the most powerful tax planning tools available to you in Canada. But here's the issue. Most high earners with corporations aren't using them to their full advantage. They're drawing income the same way year after year, leaving thousands or even hundreds of thousands on the table. Let's talk about what you should be doing. Income splitting, where it still works. Even with the CRA's tax on split income, TOSI rules, income splitting is still viable in many situations. Paying dividends to a spouse actively involved in the business. Distributing income to adult children in specific roles or with shares in the company. Using reasonable salaries to family members performing services in the business.
So I really want to specify this because this is really intriguing. And I should shout out the channel here is Danny Perro, Wealth Point, Canaccord Genuity. Go check this video out. It's really great. But I just want to highlight a few aspects, being this first one that is something that I'm actually doing right now through my corporation, is actually paying out my fiance as she helps with the business. And I can keep it as kind of, I'm not paying her a dividend, but what I am paying her is just a base private, as a private contractor. And the best part about that is it allows her now to operate as a sole proprietor, where she's able to write off some of her expenses. So I can pay her under $30,000. And I just want to add this anecdotally, that if you make $30K in a business, you now qualify for HST in Ontario. So if you're where I live, not all provinces like this, but we have to pay basically a sales tax, on top of the corporate income tax rate. But the sales tax is really annoying. It's 13%, and you will have to pay it if you make over 30K a year. But I pay her 25K a year. She doesn't have to pay that 13% HST, and then she can just pay it as a base, income side hustle on top of her salary, because she's in a lower bracket than I am and she is employed. But if I pay her that, then what she can do is write off a bunch of her expenses because she wasn't able to before. And then all of a sudden, like, the money I'm giving her is also getting more and more tax reduced because she's writing off some of that, some of her expenses that she would have already, but she's using toward the business. And again, we're not trying to break the law here. No one's trying to do anything illegal. These are just really, intelligent ways of utilizing a business and saving a lot of money. We'll talk more about write-offs in a moment, but I think this is a crucial one because I don't talk about it a lot. And it is something that I personally implement, and many people could implement with their children. Give shares. I mean, you could split up some of your corporate shares and give it to some family, and you could pay them a dividend as a shareholder. There's a lot of different ways of structuring the payouts that significantly can reduce tax implications.
Done properly, income splitting can lower your household tax bill significantly by lifting income from a higher earning individual to a lower earning family member. The key? Documentation, purpose, and timing. Number 2, income deferral. Many business owners don't realize they don't have to take out all their income every year. Instead, leaving retained earnings inside the corporation and benefiting from the small business tax rate, which can be as low as 12.2% in some provinces. That means your corporation earns $500,000 and you only need $150,000 to support your lifestyle. The remaining $350,000 can be invested inside the corp, used to fund future expansion, real estate purchases, or even insurance. Deployed strategically later when your personal tax bracket may be lower, after retirement, for example, or a business sale. It's all about.
So I like what he says here, because you can use it similar to an RRSP where you withdraw when you're in a lower bracket and you could leave it in there for the time being, which is exactly what I typically do. And it's part of this portfolio broad view that I show you guys, because if I make some money in my corporation outside of what I might pay out to my fiance here and there, I have a job, I have the side hustle income. So I leave the side hustle income within the corporation at which I will invest it. Now, do keep in mind, there are tax implications that come with what we'd call passive investing in a corporation. And a lot of people kind of avoid doing it because they think that's a detriment. But the reality is you might end up paying, if you have a long-term investment in there, you could see yourself paying up to a 50% tax rate, but that is only on the inclusion rate of 50%, because the government was supposed to raise the inclusion rate to a 60, I think it was in the low 60 percentile range, where that amount of money is what you'd have to pay tax on, but they're leaving it at the 50 percentile range. So that just means if you pull out, you make a huge gain, let's say you're up 50, 100% on the S&P, you pull it out, you might be paying a 25% tax bracket on it. And then you also got to conclude about the taxes you're going to pay once you pay it out to yourself, whether you pay yourself a dividend, which we've talked about, the ineligible dividend tax rates, all that stuff. Regardless about how you feel, you're going to have to pay some tax in a sense. But the way I like doing this is that it's deferring the tax I would have to pay on that money in my personal name. Because if you are already in a higher tax bracket and you might be paying 40 or 50+%, if you leave it in the corporation, now you're only going to be paying upwards of that 10 to 12%, depending on your province, in that first $500,000. So I'm saving almost like a 40% bracket at which I'm able to invest it deferred now, let it grow, and then maybe pay the tax later down the road. But in the meantime, it's tax deferred growth, really similar to an RSP. It kind of reminds me of an RSP, but with a little bit of tax implication up front. But this is like the extreme, and I'll break down a little bit more about a corporation versus sole proprietorship and ways of doing this. But let's just listen to a bit more of this.
Tax timing. You defer tax today so you can pay less later. Use a corporate investment account. If you're not reinvesting retained earnings, don't let them sit idle. A corporate investment account allows you to grow wealth inside your corporation, structure investments or capital gains and dividend income, use corporate class funds to control taxable distributions. Just be mindful of the passive income rules.
Yes.
Once passive income inside the corporation exceeds $50,000 a year, your small business tax rate starts to erode, which brings us to another tactic.
I will say that too, that a lot of people get concerned that it'd be so hard. I mean, you have to imagine that when you're pulling a gain off a stock, to have a $50,000 capital gain, that means you would have had to, let's just say you bought a stock, you put $100,000 in and it went up 50%. Okay, so you're up 50K. You would have to sell the entire position at that moment, all 150,000, to actualize the $50,000 capital gain. There's very few people in a circumstance where they're doing that. But again, you could look at it from a few different vantage points, where maybe you're in retirement, you're starting to withdraw from your corporation. Well, don't pull out more than 50K. But if you are, maybe your corporation isn't really making money anymore and it's just focused on as a holding company. But he does mention a few details in here too.
Use a holdco to manage investment income and preserve your small business tax rate on your active income. Integrate insurance and estate strategies within the corporate structure for tax-efficient succession planning. Bottom line, you're incorporated and you're not using your corporation to strategically split income, defer tax, and structure long-term wealth. You're leaving opportunity and money on the table.
And it's not even just opportunity or money. It is just the ungodly amount of capital you're not paying in taxes. Like, I wish he sat there and gave like an actual clerical example of the difference in taxation if you were making, say, 100,000, $250,000 a year, say a household income, or you had kids, you had a wife, depending on how you structure all of this together, like, will insanely make a difference on that taxable income. And again, he doesn't take into consideration the write-offs either. And I've said this time and time again, you should be a sole proprietor. You should have a side hustle of producing income at something and utilizing write-offs, because regardless of how you're living, you still need to drive around. You still need a phone bill. You still need internet. You're still going to have lunch, but that could be significantly reduced if you're also using that for your business. So if you have a job and a side hustle, well, now you can actually start getting some tax dollars back that you're spending on stuff you're buying already. This comes back to a point. There's a difference between a corporation and an individual. An individual pays tax on the salary earned, and they pay tax on the stuff they buy. A corporation makes money, spends that money first, and then pays tax on what's left. You still have to pay tax on what you're going to buy. You're still going to pay HST or whatever the service tax are on that thing you're going to buy. But guess what? You don't have to pay any earned income tax on that money you spent on it. So if you're buying a $50,000 car for a business, that normal person would have to go out and earn, that 63,000 because they're going to pay that 13,000 in tax before they buy the car. Corporation's already saving that 13 grand just by buying the thing that you're going to need anyways that you're using for the business. Now, obviously, you have to talk to an accountant and do this intelligently. You don't want to be too stupid about it because I'm not telling you to break the law, but you need to play within the realms of what the government is telling you is possible and take full advantage of it. And this could include trips. You could turn what should be vacations into some sort of business travel expense. You could use it for social media if you're running social media accounts. You could do diligence trips to meet up with people that are related to your work, and then try and kill two birds with one stone where you're getting a vacation out of a business trip. Obviously, you got to be careful about what you're doing. The CRA can very likely come knocking on your door, but this is what the rich people are doing right now to take advantage of this entire system. And I know a lot of people are sitting here and thinking starting businesses are hard, but if you find a passion, it's really not all that hard. You just want to find where your passion meets demand. Like this Zelda mask I have up here. Maybe I'll use this as a quick example. This is a really fine mask. It's a high-end. Maybe I grab it. I got my shorts on. I'm not wearing my my boxers under here today. We got actual pants on under this suit today. But let me grab this mask because I think this is a good example of supply and demand and people that love something and are able to turn it into a business. Let me grab this real quick here. So I think this is a great example because I am somebody, just like anybody out in the world, that grew up with the nostalgia of playing, Majora's Mask, Zelda games. And I'm somebody with taste in masks. I generally like masks. I have actually other masks over here. And I've always loved the Majora's Mask. I think it's like one of the most iconic, other than I got to reline these up because if any Majora's fan is killing me right now because they know I haven't aligned the colors right here. But still, this is a really beautiful high-end mask. I have a passion for this. So I'm like, look, I don't want to buy something cheap. There's only one company in the entire market that sells high-end masks like this. So they recognize that there's people like me that, for a product are looking for a product that is in a higher end level that just looks great. And I'm willing to pay an extra for that. This person is collecting a high-end premium because obviously this can't cost that much more to produce than maybe a cheaper one because there's a lot more labor involved, but he's able to charge a heftier premium on this because he knows that somebody's going to be looking for higher end taste in a product like this. So you have a passion, somebody that loves the game like I do, and then you have people like me that want to buy this. So they have the passion for making it, and I have the passion for collecting it. So this is something really simple that somebody's probably doing on the side and probably making a pretty healthy income off of it. I don't know what the sales are for something like this, but you could even look in our condo building as simple as walking dogs. Like somebody could go out and be like, I love animals. Me and my wife talk about this all the time. Walking dogs is really simple. If you live in a condo complex, go put a sign up with the board and say, hey, I'll walk your dogs for you, and turn it into a business. I know people doing that are making six figures a year. I know people that clean windows, everything, you name it. There's an opportunity out there for you to take advantage of. You just got to have some passion behind it and then start really looking at the scope of what that opens up for your savings and your financial future and building a strategy that eventually, turns you into a millionaire. At least this is what I've done to get to that kind of millionaire status. But obviously, I accidentally fell into this. I had to learn it for myself. And now I feel like there's so much good information out here that I wish I knew this a little bit earlier on. But let's look at a few of your Q&As here, folks. We'll scroll back up to the top and see if you guys have any questions about this stuff. But I think this is probably one of the most brilliant things. Go watch that guy's video, take this in and really understand it. Because obviously, I'm not going to tell you how to open up a corporation. I don't want to get into sole proprietorship stuff. You can Google this. You can go talk to a bank, a CPA, your tax advisor. It's not that hard. It is just putting a little bit of effort in to get the paperwork and the stuff figured out. And it's not that expensive. Corporations, I wouldn't start up unless you already are making a fairly sizable amount of money that you're not spending, that you don't want in your personal name. However, corporations are next level. And that level, I think, requires a minimum of like maybe making 100K a year and only needing like 50,000 of it to live off of. And then you have an extra 50K in the corporation to spend, because you will spend more on accounting. Corporations do come with some higher expenses over traditional like H&R, $100 to do your personal taxes. Because I think I do most of my finances and I'm paying like $1,200 a year just to get the accountant to sign off. But let's get what is here. Why would you want to buy Enbridge? We got some guys talking about some stocks in here. Yeah, Enbridge, I still own through VDY. On an individual basis, I don't think it's the worst stock. I do like Canadian Natural Resources. I think a bit more for growth. Good Canadian stock to buy tomorrow. Good Canadian stocks to buy. Like if you've got your accounts figured out, your TFSAs and your RSPs and everything. Again, I'm more of index focused. I love talking about individual Canadian stocks, but at the end of the day, like VDY till I motherfucking die, one of the best Canadian stocks out there. XDIV, those two have really great, total returns, or XEQT. If you want the S&P VFV, but I'd rather split the currencies up personally and just own VOO. We've had a lot of conversations about currency as well. A lot of people have a hard time transferring their US or their CAD to USD, and I'm still doing it now. I'm thinking about actually selling down some VDY to throw in the S&P. I'm fairly confident that with Trump's new big beautiful bill, that the market, though, might be a little bit in a greedy mode right now. The more money they print, the higher the markets are going to go. I know a lot of people were saying it's bearish for the market, but I don't see how it is. Anytime the government wants to print an ungodly amount of more money, inflation always hits the markets, regardless of how you feel. What else going on here? Damn, 16% divvy. You guys looking at some more stocks here? We can do a quick Q&A on some stocks. We'll hold VDY for 10 years. I mean, why even sell it? Like, to me, it's the best exposure you're going to get to the Canadian markets that are market cap weighted. I'm looking, when I look at these ETFs, like my goal here is to eventually not have to sell them. The S&P is something that I figure I'm going to have to take some gains off of at some point, but VDY, I just don't see the point, because it's the same thing as like the S&P for me in Canada. If you look at the holdings, with the exception of the railways and an exception of the tech stocks, which I don't like Canadian tech stocks. I don't like Shopify being one of Canada's biggest companies. I don't think there's going to be a huge moat in web services in the future when you can just prompt a website with, I'm really concerned with prompting and how easy websites are going to be to build. Still, there's a bit of finessing to them for things that are a little bit more technical, but for the most part, I don't know how well those moats last for the values they trade at, but still great companies, at least in the midterm here. But I'd rather just have exposure to Canada's biggest, behemoths that have really long foundational track records: Royal Bank, Toronto Dominion, Enbridge. I mean, Toronto Dominion's crushing it right now. I think, Canadian Natural Resources has been crushing it. Manulife's crushing it. All of these stocks have been doing very well, and VDY continues as of now to still outpace the S&P 500. I bought it at a really good time. That's why I'm thinking about selling a bit of it off right now and transferring it over, because I do want to get a little bit more S&P in my tax-free savings account. And basically on the last year, the VDY is up, close to 24% with the dividend, whereas the S&P is only up like 14%. So, and I've been holding this for a little while now, and I'm up pretty nicely on it. So we'll see what I actually end up doing with that. But the Mr. Beast of investing, you made my day, bud. You made my day on that call. I really appreciate that. I was telling my wife about that, actually. For those that like doing the one-on-ones, I had the privilege of a meeting with Matt and having some of these very same discussions. You can go to kylelivingston.com. Links in the description below if you do want to have a quick one-on-one. But yeah, good shout out to Hambone. Yeah, I love talking to you guys. Hambone's been crushing it with Cameco. What are your thoughts with the commodity plays, man? I'm really curious how you feel it's going to go moving forward, because didn't Cameco have its run so far for the uranium side of things? No, it's still doing pretty good this year. Look at that. I mean, year to date, we're still up 32%. What's uranium doing anyways? Man, this thing's gone on one hell of a run from that low. We're up 84% if you bought those bottoms there, baby. What's uranium doing right now anyways? Uranium price chart. Yeah, you did really well with that, man. The commodity market right now, I think, is one of the funner places to play around in, just because of, uranium's bouncing back up here too, which is probably much better for Cameco. But same with gold, right? Let's take a look at the gold price charts. A lot of people are saying that I was making it sound too easy to play the gold companies, but I mean, it should be common sense. I mean, if we don't know what the pull forward valuations are just yet on some of these gold companies, and you find a gold company that isn't only just mining, but is expanding their outputs in Canada, let's say, like, historically that they're growing their gold production by like 5 or 10% a year. Well, right now their margins absolutely exploded. And every quarter here, for as long as gold stays at 3,300, I mean, you could just play this, like buy them and just trade them up on every earnings and just keep taking profit all the way up until gold craters. As soon as gold craters, yeah, you're going to get hit. They'll sell off. But hopefully, if you got in this bull market for the last year and you just keep riding it, I mean, ride it till it's no longer shitting out money. I mean, it's not rocket science, right? We're in a bull market for gold. If it keeps doing this and keeps holding these highs, like, you're going to make money every single earnings period, at least for the next year, until they level off and they stop seeing the substantial growth. Because I don't think it's pulled forward that much valuation, especially if you find the right gold companies with the right production. I personally own some gold. I don't like owning physical metals over the miners themselves. And I've said this time and time again, you're always better off owning the producers because they cash flow the physical commodity. It's just that they're incredibly cyclical, and I'm not sure there's something that I'd want to be in long term, but they are things that are great to mess around with, when we're in bull markets and going through cycles. Just like a lot of people that, when they saw the cycle bottom during the pandemic for oil, I mean, you can try and play it depending on market conditions, geopolitics. It is a bit messy, but I mean, gold seems very clear right now that it's in this kind of holding bull market. Mr. Livingston, I presume, I don't know if you just aged yourself or you're referencing a book that I haven't heard somebody reference in a very long time, where passion meets demand. Good way to put it. Yeah, when it comes to building businesses, I think I think someone once told me that I've argued with friends about this, and they just said, oh, you have to be a certain kind of person to start a business. And I just refuse to believe that. I refuse to believe. I think it's hard for people to wrap their head around the technicalities and nuances when it comes to structuring businesses. That's why most people hire people. But starting a business is almost as innocent as these kids we see sitting out selling lemonade. Like, literally, it's cute. In our town where I grew up, where my parents retired, like, we drive around on a hot weekend and there's little kids propped up with lemonade stands. I'm like, again, passion, supply meets demand. Like, it's hot. People are out there. They see a cute little kid and they're like, oh, let me support his lemonade stand, right? Like, there's a business, bada bing, bada boom. I see the little things like that everywhere. It's not hard. It is not hard. Buy and hold, baby. Just trim some profits. Yeah, and diversify, right? I mean, at the end of the day, kind of getting boring at my age, for sure. If you're about to invest large sums this week, would you convert all your CAD to USD right now? Slowly convert to pick up USD at lower prices. So depends on what you define as a large sum. Obviously, the Canadian dollar has been a lot more volatile. Typically, what I usually suggest, if it's like, say you're in retirement, you have maybe $500,000 over 100,000 or something, and you want to convert it and start diversifying it into US assets, I would spread it out over maybe 3 to 6 months just to get the average of the fluctuations that we might go through. Obviously, I don't want to wait on the sidelines that long. I'm one of those people that's happy getting that capital to work as quick as possible. And I'm doing it now. Like, I'm always converting currencies to some extent. I just really don't care because I've kind of been biased toward that it's benefited me so greatly over the last decade. I have been converting, like, as many of you know, I am mostly US assets and I'm mostly US dollar. As a Canadian, almost all my money is in the United States. I mean, what do we got here? 65, 75, around 85% there is just sitting within the US markets and the US dollar. So yeah, I don't really care. I'll keep doing that. I know it affects my portfolio when the dollar jumps up like 5%. But I don't care. Like, I'll just keep converting and buying as my money comes in, and I just keep cost averaging. Depends on whether you're done or not. If you're done investing, you got to be a bit more careful. If you've got an income and you're going to keep buying, you got 100 grand, convert it, buy, and then go make the next 100 and just keep cost averaging. Who really cares? Neo and Aduro, I will update these later in the week because Aduro is, been doing pretty well. And it's been a fun one. If the government doesn't keep printing money, inflation wouldn't be so high, which would benefit the poor way more. The wealthy have assets which hold value more periods of inflation. So this is always going to be true regardless. This big, beautiful bill does not help the middle to lower class. It's just like the Canadian government giving us a quick tax break here and there. It doesn't. Saving $400 a year sounds great, but it's really unimpactful when you've seen real estate go up threefold in the last 10 or 15 years. Like, when inflation went up 12%, 8 to 12% during the pandemic years. We had 2 years there of just really high inflation. Like, none of this is impactful as literally going out, trying to make some extra money and finding ways to not pay tax on it through reduced tax systems of write-offs and whatever. That's why I'm making this video. This is why I'm telling you guys, like, there is ways to get rich. Canada wants you to be rich. The problem is the people that have been taking advantage of it have been screwing over the middle class. And, you know, the middle class have been subsidizing the rich because the rich just know how not to pay it. Like I said, anybody I know that's worth 10 or $20 million, they use debt to fund their life because, like, they just realize that I don't pay any tax on debt and it's cheaper to pay the interest from the dividends than it is to pull the dividends out in mass amounts and pay myself a salary. Like, I mean, you've seen it, like, billionaires do this all the time. It's just how they operate, right? And that's like really next level stuff. I'm not that far along where I'd be comfortable using debt because I'm just not rich enough to. But if you're worth $1 billion, you know, pulling out 100 million in debt, I don't think is going to do much for your life in any material way. It will just stop you from paying tax on $100 million. Will you buy Dollarama at this stage, holding since COVID? I would not touch Dollarama now. I think it's too expensive personally. That's why I like Google. I think there's good value if you're looking at individual stocks. I just don't want to chase Dollarama because it has become valued as a tech company right now, and it's not worth a tech company. I mean, think about it. It's valued at 43 times earnings. It's worth basically what Google's. It's worth, again, in the perspective of not looking at the market cap, right now, Dollarama, from its price to earnings multiple, you're paying over twice the amount of what Google is valued at today. And are you getting the same kind of growth rate from it? I mean, it is growing nicely, but I mean, what's the current? It's not. I mean, it's not growing at a level that, you know, I could severely justify, I think, paying a 45 times multiple for it personally. But that's just my opinion. It is still growing. It's a good growth stock for sure, but I don't know. I'm just a little on edge with the run up it's already have. They've increased the money supply by 42%. Forget tax loopholes and the rich. Stop printing money and the poor would be better off. No, 100%, 100%. I mean, it's really that fundamental. That's the reality of it. I mean, so why look at 2008 to today and ask yourself, why has the market been so steady? We've had the two best possible things happening to the stock market. We've had tech companies in the prime of this new, you know, this new technology revolution. Like, we are literally in an entire upgrade of every single sector of the market. Everything is becoming more efficient. Everything is turning into robotics and software. And it's causing this massive growth in efficiency and a massive explosion in growth. It has been the greatest growth period in the S&P 500 ever in history. And I'm very thankful to be a part of it. But on the back of that, we've also had a mass printing cycle coming out of the back of 2008 because of quantitative easing. We have the government come out and literally bail out the largest financial collapse in human history. And they completely bailed it out. They printed an ungodly amount of money, and they continue to print an ungodly amount of money. And the only way to get out of it is through growth. And the government keeps thinking, if we just can keep on a growth cycle, then who cares? Kick the money, kick the can down the road. And this comes back to the point too of, like, if you look throughout the entire history of capitalism, it has always been a stage of screwing over the middle class. There was a time, not that it was better or worse, but a time where one guy could go to work, support a household, a family of 2 or 3 kids, buy a car, pay for the mortgage while the wife stayed home. Then they started introducing the wife going to work. And now it's like, to even survive in a metropolitan area in the Western world, 2 people have to produce an income. Like, and a lot of people just aren't having kids because they can't afford to have kids. Like, that is all a cause of overprinting. And it's kicking the can down the road so the next generation gets to deal with it. And the other thing too is, like, education. Like, we completely screwed a whole generation over just through, you know, allowing student loans to be privatized by the government, or not privatized, but government subsidized. That was the dumbest thing they ever did, because, like, it took off the responsibility of the supply and demand. And that's how the markets work intelligently, is like, I don't want to lose money, so I'm going to look at where the supply is before I'm willing to put up capital risk. If the banks were to hand out the student loans, that's how they would look at it. They would say, oh my God, you know, Jimmy's son here, Frank, wants to become an entertainer. He wants to go to acting school. Well, we know 95% of actors end up being broke. So the bank's going to be like, we're not going to give you a student loan for that. You know, Jimmy, you're going to have to tell your son, Frank, to figure it out on his own. Don't tell Frankie that he's going to have to go to community college. He said, we're not going to give him a degree for this. But meanwhile, the $1 trillion that these Harvard universities are worth are now so screwed and ass backwards that if you are in an underprivileged situation, you get a free education today. That's because they've just taken so much money from the system, screwed over such a huge percentage of, like, the millennial population in the United States, that now the government, with their big, beautiful bill, is saying, guess what? Now we're gonna friggin' you can't bankrupt it, which is insane. And now we're gonna garnish your wages and we're gonna increase the amount you're gonna have to pay back so we get that money back sooner. Talk about corruption at its finest, right? Government should have never done that. Screwed over an entire generation. It's a shame. It's an utter shame. Kyle, is your VOO in your RRSP to avoid withholding tax? What do you buy? You're in your TFSA. So, like I said, I think I'm making a mistake personally because I'm not using the dividends today, owning VDY. I did buy VDY at a great time, and I do want that Canadian exposure. It's why I keep it limited to the level that I have it to right now, because it's 15%. It's a fairly small position, even between the wife and I on our combined accounts. But ideally, in my TFSA, as mentioned, you want to maximize the tax advantages. And a lot of people think, I'd rather hold VOO in a registered retirement savings plan because then you don't have to pay the withholding tax, the 15% over the border for dividends. But honestly, I don't really care about that all that much because you're getting a 1.5% yield off VOO. So to pay a 15% on that is incremental. So I like owning the S&P across all my accounts. I own it in my TFSA, and I'm going to buy more of it by just slimming down VDY a little bit because I want to own VDY. I just don't think it's efficient in my tax-free savings account, but I don't have my TFSA maxed out yet. But probably by the time I get it maxed out and I have extra capital to invest in a regular account, at that point, I might start transitioning more VDY from my TFSA to a regular brokerage account and then start looking for where tax advantages are better, which are on U.S. capital gains stocks, non-qualified dividends. So even though I have to pay a 15% withholding in my TFSA, I don't really care because I can pull that out thereafter tax-free and realistically, not having to pay anything else after. I don't really mind. So I might start shifting more to growth stocks in my TFSA, like the S&P 500, like Google, like Take-Two. I'm thinking about adding Meta to my TFSA as well and just maybe focus a little bit more growth in there. And again, just spread the rest of it across all my accounts. I'm, again, mostly US anyways, but I don't really care. I just want basic S&P exposure, fairly equated across every account with a minimum of 100,000 in every single account. Right now I have 100,000 in VOO and my RSP. I have over 100,000. I think I have probably close to, I'm not sure what it is, probably 120, maybe 120,000 in the S&P in my corporate account. And then I have about probably about 70 or 80 in VOO in my TFSA right now, give or take there. But I want to get that up to about 100K at least in my TFSA. So, but yeah, I don't really care. I'll just put it wherever. I'm not going to like finesse little bits of withholding tax. Now, I wouldn't hold. There's no reason to hold dividend US stocks in a regular account because you're just going to get screwed. It's an unqualified dividend. You're going to be paying withholding tax. Like you're just going to get far too ripped. But honestly, I don't think it matters as much as tax efficient it is in a TFSA. So Barrick Gold, yeah, maybe Barrick, if you're looking at some of the gold stuff, might not be the worst idea. Again, if you want to trade it, I'm just looking 6 to 12 months out. And if I'm looking for a trade, gold is probably a good place if you're looking at things like Barrick. If you want to own individual gold stocks, only two worth owning. Yeah, I agree. Maybe not in totality, but yeah, the big guys, the big boys are usually the ones you want to play with. My neighbor just sold this house in Vancouver, says Canada's going downhill big time. He's working out of Bermuda for tax reasons and living in Bermuda 6 months a year. So a lot of Canadians right now are looking at, the best thing about Canada is they let you leave the country without paying Canada taxes and still being a citizen. A lot of countries do not let you leave and go work in other countries, but while remaining a citizen. But what you really want to do, I don't think you need to leave Canada. I don't know. Define Canada going downhill. I mean, I've been around, I haven't been around the world, but like I've been to a lot of other countries and I'd still rather be here, especially for a lot of tax efficient reasons. And there's a lot of beautiful places. You can find lots of pockets of paradise. I mean, a lot of beautiful places to live amongst Alberta. I mean, Nova Scotia. There's a lot of beautiful places. You could find little nooks and crannies where you could find a comfortable, lower cost of living. Small towns tend to do better for healthcare. A little bit, doctors are more reasonable and easier to get a hold of, stuff like that. But personally, I just, I don't see myself doing the nomad thing because I have a life here and a family here. But honestly, Canada is such a great place because you can go live anywhere, make money abroad if you do have that nomad life. And he looks like he's just taking full advantage of being a full-time Canadian while traveling a bit and taking full advantage of outside of the country for 6 months. But honestly, Canada lets you make money abroad and not pay really, the digital service tax that Trump is fighting Canada on right now. And they're obviously probably going to get rid of it. I think you need to understand that if you want to get rich, if I was starting out today, I would figure out exactly like what I'm doing, figure out businesses where you can sell digital services to the United States, because it is the weirdest thing in the world to me that you can sell a digital product to a client in the US, get paid in US dollars, you pay no withholding tax, you don't have to pay the IRS anything, and Canada doesn't charge HST in Ontario on that US because it's foreign income, and then you just pay the marginal corporate tax rate on the first $500,000 earned. So as a Canadian citizen, I could equivalently make US income and pay a far less tax rate on it than if I were to sell a physical product over the border and have to pay tariffs, or going over there with a green card and actually working. I don't know. It blows my mind, right? So that's where Canada said, oh, we should be charging these businesses a digital service tax because we don't make any money. And it's just kind of free floating capital. But meanwhile, if you live in Canada, the government's like, hey, go take all that money from all these foreign governments and bring it in, because this digital service tax, it ain't going to last forever. There's just no way. Because it just seems crazy to me that we're allowed to do that. It's not just the US. You can go do that with Europe. I think a lot of countries right now allow you to make and sell digital products. Kyle going to dump Rogers and Telus stock and putting the dollars into XEI. Probably not the worst idea. I don't know if XEI is the best place. I think XEI is good for retirement if you just want a higher yield. But honestly, as total return matters so much, I think XDIV or VDY are better options. Because XEI, I think, averages like a 6 or 7% annualized, whereas XDIV and VDY are around 10% annualized. You're kind of leaving 3% on the table, thinking you're getting a bit more out of the dividend, but you're not. None of my friends want kids, and the ones that have one seem depressed to me. To be honest, we debate having kids a lot right now. Financially, I think we can make it work fine. Like I said, I think if you're financially set up for it, it's a lot better. I think having kids can be very rewarding. Personally, I'm not like for or against it, but as I age and I have family and I'm more settled down, I kind of romanticize, I guess, the idea of having children, but I guess it's just personal preference. But again, it matters how, if you're broke and you have kids, I could see you being depressed. I mean, you got to make sure you're financially stable and have good jobs if you're going to be doing that. When the interest rates were low for the past 15 years, the government could not grow. Instead, debt grew. Today, with rates being much higher, you think they can grow? Let me reread that. When the interest rates were low for the past 15 years, the government could not grow. Instead, debt grew. I'm not sure what you mean by that. I'm curious. Today, with rates being much higher, you think the government can grow? I don't think the rates affect government growth. I'm not sure what you mean by that. At the end of the day, the government is just supposed to be focusing on a few select things. That's what we vote them in for. Roads. I don't think it's the government's job to get involved with housing. Housing is a free market product. Housing got expensive because supply and demand. The only thing the government did was let immigrants in. And the problem was if you fought the immigration for the last 5 years, you were looked at as a racist. Now, all of a sudden that it's a problem, the government is kind of freezing immigration, or at least slowing it down until like supply and demand can catch up. But it is a free market product. The government shouldn't be getting interfered with it. I mean, if housing is worth that much and they should be able to build, you're going to get into modular homes. That should all be free market. The government shouldn't be overly involved, in my opinion. But I don't know. I guess that's just the government doesn't really grow much by GDP, right? I mean, they don't grow much by interest rates. They grow by GDP. So they need immigration to grow the country, and, taxes. They want you working, right? So the economy can continue to grow. Best thing you can do is load up on Bitcoin in your TFSA. So this is something I've been thinking about a little bit, but not Bitcoin. I actually have been looking at Ethereum recently, and I told you guys I don't like crypto all that much because it hasn't materialized into a business model. Bitcoin, I can't tell the difference between it and a Ponzi scheme. Yeah, it's great for international money exchange, but otherwise the white papers were pointless. Bitcoin has become something that it wasn't initially intended for. And right now it's so big, people would rather build around what the attention is than actually go look at something that has more of a utility behind it. But I think Ethereum has way higher utility behind it. It's been lagging Bitcoin greatly, and I can see a better future in it. And yes, from a growth standpoint, I think taking on that risk in your TFSA might be more appropriate because the rate of return and the tax advantages would be far superiorly higher. You just don't want the loss. It's really scary because if you lose a lot of money in your TFSA, you lose that contribution room forever. But balancing that risk could be very appropriate, and that's how I've done it in the past. I'm thinking actually about buying a Ethereum ETF. Now we have Bitcoin and Ethereum separate in wallets, the way it should be held, but it would be great to own it under a tax sheltered account like that. And yeah, we'll see if I do it in the future. Stay subscribed. I've been thinking about it because Ethereum's starting to move in a really good direction. A lot of the banks right now are starting to tokenize. We're seeing tokenization with a lot of weird derivatives coming off things from Robinhood, I think, for things that are privately traded. It's really weird at some of the derivative market is using Ethereum right now because they're trying to get the blockchain to, start attaching them to some of these less liquid equities. So it's a really intriguing place to be right now, I think, if you're in the right cryptos. So maybe who knows? We'll see what happens. Kyle, I want to cut SAHD by 50%. What do you recommend for US exposure? Well, it depends on your age and what your goals are, right? I mean, I'm not a financial advisor. I don't know what your time horizon is, your income. For me personally, again, I'm 70-80% United States because that's where the growth is. I don't care about politics. Politics do not inflect upon my investment decisions. I just recognize that, yeah, there are a lot of overvalued companies in the United States like Tesla, Costco. There's a ton of companies that trade at far too high multiples for my liking. I don't like the growth rate Pepsi has. There's a lot of stocks like that I don't like, but I do recognize that technology is still the future. And I still think, though Apple might be a bit expensive, Microsoft's expensive, I think there's a lot of undervalued players out there like Meta, like Google. There's always that ebb and flow of things that are cheap and things that are expensive. But regardless, I still think the future is tech. And I think people are severely underweighting the growth potential of margin expansion. And I just want to be where I think that's going to happen. Doesn't mean it's going to happen for the next 10 years, but it did happen for the last 15 years. And I've been ever grateful to be a part of it. And like you, I sold out of my entire SCHD position after the underperformance for the last 5 years. Now, God knows, just like you, your luck may have it that as soon as you sell it, it rallies. I have over 200K in SCHD. Yeah. So, I mean, I've recommended other investment vehicles. Now, I wouldn't put 100% of it into SCHD or any of these other stocks. I would diversify it a bit, but I do like Devo as an alternative to SCHD, and I've talked about that in the past. It's a covered call ETF that has about a 12% annualized return. The yield is much higher than SCHD. I think they've done a great job at not only concentrating the growth, but diversifying the risk as well through a multitude of different sectors. I don't know. I've talked about this, and I'm going to do a specified video on it, but many of you are probably well aware of Devo. It's probably a really good stock if you're looking for income from your RSP. It's always good to look at a withdrawal plan too from your RSP because you don't want to wait till retirement to pull it out. I plan on drawing capital from my RSP long before I'm forced to by the government. But I mean, if you look at Devo here, I think it's not an end-all be-all solution, I think, but it has a long track record of being through volatile periods. It checks a lot of boxes for me. Yeah, the expense ratio is a bit high, but 0.56 for a covered call ETF to me is pretty cheap. Current yield is 4.73%. It pays monthly, superiorly higher than SCHD. They're writing covered calls against international business machines, Meta Corporation, RTX Corp, Visa, Microsoft, Goldman Sachs, Home Depot, JP Morgan. Not one of the investments make up more than 5% of the total holdings. Very diversified between financials, information technologies, industrials, consumer discretionary, healthcare. I've never seen a covered call ETF I like more than this personally. And since inception, it's annualized 12%. So I'm like, it's great. I think it really does a good job at diversifying and spreading risk out. So I would probably choose this, but I don't think I would dump 200 grand in it if that's like your entire RSP. Maybe split it up between global market funds, US funds, things like this, and just maybe pick 3 or 4 ETFs that divvy you up across a multitude of investment sectors. Kyle, do you have Blossom? God knows I should be on it. I do have it, but I only do, I don't post to it. I just personally like having it to look at what people are doing. Really, guys, the problem I have right now is if I was smart, I should hire a social media manager because I focus down on a few things at a time. I'm running like a side hustle business. I have a primary salary job that I have to focus on full time. And then I have my social media accounts that I use as somewhat of a funnel to get sponsorships and things that I use for my side hustle. And you have to understand, I only have so much brain capacity. I used to do TikTok, and TikTok is a great platform, but I can't do everything properly. So right now, my only focus is YouTube. I do YouTube, what I think for me successfully. It really does a great job for side hustle income. It makes me a great income. So I'm like, why do I need to focus on everything? Let's just focus on YouTube. So I do use Blossom. I do use X periodically. I like Stock Twits. I use that. You'll see me post there. I do use all these social media accounts, but I can't put the level of professionalism into them as I can on YouTube. So I just kind of pulled back and said, hey, this is my home for now. If I was smart, I should go find some cheap social media guy that can post all these different channels for me and start growing some, because that would probably be the intelligent thing to do. Kids are the best. Yeah, I guess it depends. Like, yeah, if you love kids, go for it, man. Back to that conversation. What about Solana? Solana's okay. I've told you guys, I thought the real banger in crypto for me was going to be the metaverse plays. I said the real first business model for crypto that would ever start to surface. NFTs were a joke. They should have actualized already, and they haven't in any material way. Smart contracts are starting to, luckily. That's why I like Ethereum. I think Ethereum's probably pretty cheap right now, if that's the case. If it's not the case, it might not be, who knows. But I really, really thought that with Mark Zuckerberg talking about it, with like Dr. Disrespect, now that he's left Midnight Society, breaks my heart, that video games were going to start implementing NFTs. And we were going to have a world that we would be able to pull out literal in-game items into a real world economy. So if I made or got something that was a limited time drop from Fortnite that Disney did as a collaboration, I would be able to sell that limited Disney drop like a Pokemon card in a third-party auction system or through some kind of a blockchain. That is where I thought video games were going to have this mass period of explosion and growth, because now the artist can make money on all those drops in perpetuity forever. In a smart contract, every time that thing trades hands, it could say that the company makes 15%. I look at that and I was like, what a friggin' business model. And it hasn't happened yet. And it breaks my heart, because I told you guys I was watching a bunch of metaverse plays and they just haven't worked out at all. So I haven't bought into them because I haven't seen any actualization yet. People got to understand, this is the same thing with Tesla and the same thing with a lot of companies. When the business doesn't actually exist, you have to understand the absurd amount of risk you're taking on in the interim. And if you are overpaying for that risk, you might not see a rate of return for 10 or 20 years. That is what happened in the dot-com bubble. That is what I'm suspecting is happening to Tesla right now, is we are in a 5-year flat market already for Tesla stock. That is what's going to happen to Palantir. That is what's going to happen to so many companies that are pulling forward far too much valuation where the growth hasn't been justified in the business model yet. So just always be aware of that, because it's true for crypto. That's true for anything you're buying. That's why it's nice to look at things like Google. And again, I'm not saying that as financial advice, but between the wife and I, we own a substantial amount of Google. Google's now almost 10% of my personal portfolio, but that's because I recognize the business model isn't eroding like people think it is, and they have a lot of growth vectors they have time to actualize on. Same could be said about Meta. I mean, we were joking about this the other day, and maybe I'll finish up with a few anecdotal ways of like analyzing stocks. But Meta, I think the only two things that are severely going to pump them up in the midterm here, in the short term, that I'm very excited for, is if you go to the App Store. And I always like seeing like what are the most downloaded apps, right? Like you want to kind of get a feel out. Let me just pull it up here real quick just to give you guys an idea. Where is my App Store? It's like hidden on my phone. Can I just search it here? App Store. If you go on the App Store, guys, and you just go look up the most recent apps and the most downloaded top apps right now, let's go take a look. So if you look at the top downloaded apps, this should give you like a real clerical view of what businesses are succeeding right now. You have Temu, you've got ChatGPT. I mean, you've got Threads. Threads is the third most downloaded app today. When have you ever heard anyone say anything about Threads? Everyone's go watch me on X. Threads right now has 2/3 the users that X does. Threads is almost as big as X is, and it's the third most downloaded app. That is wild to me, and no one's even talking about it. I'm like, Meta just started a brand new social media business today that would trade in the S&P 500 literally within just a couple years, 2 or 3 years. How long has this Threads even been around for? You know, crazy that is. And now they're starting to monetize WhatsApp. So I'm like, those two businesses alone will probably add, who knows, over the next 5 years, an extra 30 to 50% to their bottom line. I wouldn't be surprised. And at least Google's the fourth most downloaded app still. So I'm like, when you look at this, like, you know, you get a real feel out for where people's attention is going. And like, you know, when you see such deep discounts in Google, and Meta, I think, is trading at fair value today. I don't think it's trading at cheap multiples like it was, but those are my two focuses only. Like, I'm not trying to complicate my investing journey. I'm still somewhat of a fundamental value investor. So when I see value and growth come together like that, it's like the Warren Buffett inside of me is just like, I'll take the short-term risk. No guarantee it works out, baby, but it might. I wish I would have started sooner, but waited until we were comfortable financially. Well, I mean, it comes back to what do you mean you wish? Oh, to have kids? Is that what you're talking about? Yeah, I mean, that's a debate, right? I think a lot of people, like Kevin O'Leary, said they wish they had kids sooner. I don't know, but then you have people having kids in their 60s, which is nuts to me. But yeah, we'll finish up with one more question here. Do you think the CAD market, like VCN, is worth having like 30% of your portfolio, or US market VO? So if you are not a diehard investor, this is my job. My full-time job is market involved. My side hustle job is mostly all market involved. This YouTube channel is all market involved. Every day I'm looking at the markets. So I'm fine taking on the risk of owning individual stocks, because if the market changes, something makes me uncomfortable about the business, I will sell out with no remorse. I'm not somebody that sits here and fantasizes that I'm going to own this company for 20 years. I'm not one of those. If I'm making money on the stock and the business model changes, I'm not going to stick around. I mean, you guys sold me. I flip-flopped out of Google already. When I started buying Google and then I started getting scared that ChatGPT was going to ruin it, I sold out of it, just like everybody else did out of that fear. But time has gone on. It's been well over a year since I sold and bought back, and it's been 2 or 3 years since ChatGPT's been out, and their search business is still growing. So it's bullshit if you tell me that search is dying, because if it was going to die, I think it would have already started to plummet, and it's not. So I'm not too worried about that. But if you don't have the comfortability to do that with stocks and ETFs, don't go buy 10 or 20 ETFs. Don't go look at all these ETFs, be like dividends here, growth here. The end all be all solution is something like XEQT. You do not have to buy XEQT. There are a variety of versions of it. I think, is it VTI or VT if you're in the US? Like a global market ETF is what you want. That's market cap weighted. XEQT is a good end-all be-all solution. If we take a look at it, the reason it is because it gives you exposure to everything that matters in the proper weightings. So 43% US, 25% Canada, and then the rest weighted across the world from Japan, United Kingdom, China, all that. So I love these kind of ETFs, and we're starting to buy them now because I'm starting to move into wealth preservation. But this ETF is a good end-all be-all solution because you get, and since inception, it's annualized 12.54%. The current starting dividend is right around 2%, 2.03%. I'm like, you can't really go wrong. You're getting a really good little yield that's higher than the S&P. You're getting global diversity with really great global market returns. You can't go wrong. Cost average into this for the rest of your life. And then if you have a little bit of an itch to gamble, maybe take 10% of your portfolio and go gamble on ETH, crypto, Google, whatever you want. Would be my recommendation. So, but otherwise, I do hope you guys enjoyed the stream. I hope you got a broad view of conversation, whether it be corporate tax investing, starting businesses, sole proprietors, incorporating. Hopefully you can take all of this knowledge, base it into, nothing happens overnight, but take that knowledge in just like I did 5-10 years ago, and just slowly start putting each brick in your wall of your castle until 10-20 years go by. And before you know it, you have a castle, and it works out every time, unless something detrimental happens, which God bless, you have your health, your family, all that. I'm telling you, if you just do this for 10 or 15 years, you try and put away 30 to 50% of your income. It's not easy, but if you do it, you'll be a millionaire pretty quick. It does not take long to become a millionaire. I don't think it's hard to become a millionaire. I think the path to becoming a millionaire is the hard part. People just do not have the patience. I'm not selling a get rich quick scheme here. It takes 10 to 20 years to be financially set up. If you are making normal income, side hustle income, maybe you get lucky, you find a banger, you make some quick money like we did. No guarantees that happens to anybody, but I promise you, if you get on this path, you're going to end up in a much better position than you were when you look back in 5 years. So stay cool, stay awesome, folks. And as always, I look forward to catching you in the next one. Peace.